Hello everyone, a very good evening. Welcome to the mini marathon for our module D of our RBWM syllabus. We have already covered our module for the three modules A, B, and C. If you haven't watched the videos are there on the YouTube channel. So make sure that you watch these videos. They are very important for your revision. Download the PDF, use the theoretical part for revising the topics. These are the most important topics. All right, so when we talk about our module D, there are 4 units. Module D holds a good weightage, around 25 to 30 mark questions come from our module D itself. All right, so we'll be following the same thing. You'll get a question on your screen. I'll give you 10 to 15 seconds to comment down the correct answers, and then we will discuss the aspects, the topic related to it. All right, so let us start. Okay, so here's the first question. The question says, which of the following statements are true about the mandatory convertible bonds? Now, the unit 23, the importance of wealth management. We have discussed the meaning of wealth management, the meaning of investment, and we discussed the various products and services for managing our wealth. So alternative assets are there, bonds are there. We can invest in the insurance, mutual fund, real estate, all of these things are there. Under the bonds, one type of bonds are the convertible bonds, right? So which of the following are true? They obviate the investor to convert into equity. They are typically issued by the state governments. They offer higher rates of interest than the regular convertible bond, and they allow conversion at the investor's discretion. So, which of the following statements are correct about the mandatory convertible bond? Drop down your answers. Till then, let us discuss what are bonds. Bonds are debt instruments. They are fixed income instrument wherein a debt, a loan is forwarded by the investor to a borrower. The company who is issuing the bond is the borrower. The investors, they are forwarding this loan. So the issuer promises to pay a specific interest over the life of the bond, and at the time of maturity, the principal to the investor. They're issued by governments, corporations, municipalities. Bond market are rather stable, right? They're not as volatile as the equity market. So those investors that have a lower risk tolerance, it can be an efficient way to diversify their portfolio. Okay, what do the bonds do? They help these issuers raise capital, long term capital. There are two types of market, primary market and secondary market. These things are very simple. Primary market, where for the first time the bonds are issued, right? The issuer directly sells the new debt securities to the investors. And in the secondary market, the investors, they themselves trade the bonds that they have purchased from the primary market. All right. Now, types of bonds, there are convertible bonds, there are government bonds. Under the government bonds, there are various types. Municipal bonds are also there. I haven't still received any answers. C. C is 1 and 3. They obviate the investor to convert into equity. Yes, and they offer a higher interest rate. Correct. The correct answer is C. 1 and 3. So, what is a convertible bond? Here, the bondholder, the investor, they have certain option, or they have the mandatory, sometimes it becomes mandatory that at the time of maturity they cannot redeem the bond. They will have to become shareholders. So when this conversion is offered, it is known as convertible bond. When the conversion is optional, it is a regular convertible bond which gives the investor merely the option to convert their bonds into equity shares at maturity if they want. Then we have the mandatory convertible bond. that give an obligation, they make it mandatory for the investor to convert it into equity. And then we have the reverse convertible bond, wherein the option is given to the issuer. At the time of maturity, if they want, they can convert it into equity shares. Now, in the mandatory convertible bonds, there's an obligation, so they offer a higher rate of interest. So the correct answer is C. I hope all the types of convertible bonds are clear. And again, download the PDF, go through these points, the definition of regular convertible, mandatory convertible, and reverse convertible I have included here. All right, next question. Which of the following best describes the repayment source for general obligation bonds issued by municipal bodies? So, municipal bodies, the municipal bonds in India, they can be the general obligation bonds or they can be revenue bonds. So, what is the repayment source of the general obligation bond? General revenues from the municipality, revenue generated from specified projects, grants from the central government, or donations from the private bodies. So the general obligation bond, yes, the correct answer is A. The bonds are issued for general projects, right? Not for any specific project, but general projects. And the finance for the project, the repayment will be done from all the projects that are undertaken by the municipality. Revenue projects, however, the bonds are issued for some specified project. The municipal body is raising funds for some specified project explicitly for that project, and the repayment will be from that project only. These revenue bonds have a higher maturity period. It can be extended up to 30 years, and they also have a higher returns as compared to the general obligation bonds, right? We have also studied about the government bonds, bonds which are issued by the central and the state governments. I hope you remember them as well, right? So government bonds, period 5 to 40 years, fixed rate bond, floating rate bond, sovereign gold bond, inflation indexed bonds, zero coupon bonds, right? Let's move on to the next question. Which of the following are true about the debt mutual funds? Now, what is a mutual fund? If the investor puts their money into the pool which is maintained by the portfolio manager, and the manager, they invest the complete pool into the various securities, bonds, or any other area. Here the investor, they do not own these securities or bonds, they only get the units. So the mutual fund is beneficial for those individuals who do not have a very large source of income, who do not have a good amount of accumulated wealth, and they can invest in smaller amounts, so they will get the units. So now we are talking about the debt mutual fund. They invest in treasury bills and government bonds. They offer fixed rate of returns, primarily equity based or suitable for high risk investors. D. Absolutely. The correct answer is D. Okay, so we have different types of mutual fund schemes. Equity mutual fund, money will be invested in the stock market, right? Returns on investment are purely based on the stock performance. Debt, however, investment will ensure us fixed rate of return, treasury bill, government bonds. There's also the balanced mutual fund, partially into equities, partially into stock. Sectorial fund, a particular sector, IT, bank, FMGC, the fast moving consumer goods, pharma. ELSS, tax saving funds, under section 80C we can claim the deductions. Okay, mutual funds can also be open ended and closed ended fund. So the correct answer is D, 1 and 2. Primarily equity based and high risk investors, these are the characteristics of the equity mutual fund. Equity mutual fund. Next question. Which of the following mutual fund structures allows redemption at any time without time boundations? I told you, right? There's the closed mutual fund and the open mutual fund as well. So, which allows redemption at any time? Closed-ended mutual fund, open-ended mutual fund, equity-linked savings scheme, or balanced mutual fund? Very simple question. Yes, the correct answer is B. What is open mutual fund? Here I can invest money at any time. I can redeem my investment at any time as per my needs. Closed-ended funds, there is some lock-in period, like the ELSS, they come with a lock-in period of 3 years. Before this, we cannot redeem the funds. All right, because there's a time, it is a time-bound horizon. All right, that is a closed-ended fund. Another type is the systematic investment plan and systematic withdrawal plan. In the systematic investment plan, I do not have a good surplus to invest right now. I can instruct the mutual fund manager to deduct from my bank account a certain amount, right? Every month or every quarter. So, a fixed amount at the regular frequency I can invest in the mutual fund scheme. Systematic withdrawal plan, I will enter into an arrangement where I can withdraw a fixed amount at the fixed intervals, quarterly, monthly. So these units from the portfolio will be sold and the funds will be transferred to my running account. That is SWP. All right. These are the types of mutual fund schemes. Next. In finance parlance, how are asset management and investment banking referred to? Now, when we are talking about asset management, portfolio management, investment management, all the things mean the same. We are managing the portfolio for the customer. It is different from investment banking. How? Asset management is known as buy side, investment management is known as sell side. Both are commonly known as buy side. Asset management is sell side, whereas investment management is buy side. Both are termed as sell side. Let me, in the meanwhile, just help you revise the difference between investment management and investment banking. What is investment management? The customer already has surplus money. They want to increase their profit by investing into shares, stocks, bonds. So the manager will help them create a perfect plan that will suit their requirement. Customized, tailor-made solution. Investment banking, on the other hand, the client is in a situation of deficit. They want to raise capital, they want to raise fund. So what will the investment banker do? They will sell the shares, bonds, or stocks that are issued by the customer in the market to raise funds. So, yes, the correct answer is A. Asset management is buying side. The managers, they help the clients reach their investment goals by managing their money, right? And investment banking, they help the corporate finance needs, raising funds or capital. So, investment banking, they work on the sell side, and investment management, they work on the buy side. Investment banking will have the mergers and acquisition advisory services, underwriting services, raising capital through selling stocks or bonds to the investors, right? Mergers and acquisition advisory role for the amalgamations, mergers of two companies, of two businesses. This is offered by the investment bank. There are also the full service investment bank. Apart from these two, they also offer sales and trading, equity research, and asset management. So remember this point, the sell side and the buy side, the difference between investment management and investment banking. All right, so those clients who have a surplus, they will approach investment managers, asset managers Those clients that are in a deficit will approach the investment banking services. All right, next. In a firm commitment underwriting, the underwriter. Okay, so there are three types of underwriting services offered by the investment banker. There is the firm commitment, firm commitment. There is the best efforts and all or none. So here the institution, the question says, in the firm commitment, what does the underwriter provide? They market the issue but bear no financial risk. They buy only the portion of shares that are sold. They buy the entire issue and assume the full financial responsibility. They cancel the deal if the full subscription is not achieved. Great. Yes, the correct answer is C. You have understood the module D completely, right? Okay. So the correct answer is C. What happens in firm commitment? Let's say 100 shares are issued by the company. The underwriter is going to buy the complete 100 shares. They will try to then sell it off in the market. If anything remains unsold, they will assume the full financial responsibility. So let's say out of 100, 90 are sold, 10 remain unsold. It will not be returned to the issuer, right? The banker, the investment banker will retain it. They will retain their investment. Best effort means they will sell as much as possible and any unsold shares will be returned. So they do not hold financial responsibility of the unsold shares. So 90 are sold, 10 are remaining, 10 will be returned to the issuer, right? And the third is all or none. If the entire issue cannot be sold, the deal will be called off and the issuing company receives nothing. So even if one remains unsold, the whole issue will be returned back. There is no financial responsibility of the underwriter and they return the whole thing back to the issuer. All right? Okay. So the correct answer is C. Next. Concerning the investment bank organizational structure, consider the following statement. So, the investment bank office is divided into three parts. There are three main offices. There's the front office, there's the middle office, and the back office. Front office, middle office, and back office. The question is asking you the responsibilities of the three offices. The front office includes investment banking, sales and trading, research. The middle office handles compliance and risk management function. Back office is responsible for generating revenue through trading. Middle office acts as a control layer between front office and capital risk. So which statements are correct? 1, 2 and 4, 1 and 3, 2, 3 and 4 or all of the above? 1, 2, 3 and 4. 1, 2 and 4. Yes, correct. The correct answer is A. 1, 2 and 4. The front office is directly dealing with the clients. They are deciding. They're involved in the activities of investment banking, sales and trading, research, buying and selling the product. So the front office undertakes risks. It determines revenue for the investment bank. Middle office is the controller. They make sure that the investment bank does not engage in too much risk. They do not accept activities that could be detrimental to the bank's health. So, functions like risk management, financial control, corporate treasury, compliance. It is the point of contact between the front office and the middle office. All right. And then we have the back office, which provides the supporting activities, operations, technology, whatever is needed so that the front office can make money for the investment bank. All right, so the back office is not responsible for generating revenue. It is responsible for providing the supporting activities, operations and technology. All right. With respect to active and passive portfolio management, consider the following statement. So, in the portfolio management, what does the manager do? They will understand the needs of the client, their future goals, their current financial situation. Then they will prepare a financial plan so that they can reach their goals. Now, portfolio management can be of four types. It can be active, passive, discretionary, or non discretionary. So, here the question is asking you about the active and passive portfolio. In the active portfolio management, it aims to outperform a market index by taking differentiated positions. Passive involves frequent buying and selling to beat the index. Passive strategies incur lower transaction costs due to minimal portfolio churning. Active management typically involves lower risk than passive management. Which of the following statements are correct? Is it 1 and 3, 2 and 4, 1, 2 and 3, or 1, 3 and 4? Quickly comment your answers. So the name itself tells us the active portfolio management would mean we are actively involved. The portfolio manager, the management, they are trying to outperform the market index. Let's say a market index like Nifty is selected. The positions that are taken by Nifty, we will take different position. We will undertake risk in the expectation of greater return. So there is more churning, actively buying and selling securities. To generate excess return, higher level of risk will be there. All right, that is active. Passive means someone is just sitting, they are observing, doing whatever the market index is doing. So we are trying to mimic the performance of the Nifty or any other index, right? So here the transaction cost will be low. Why? Because portfolio churning is minimum. We are not actively buying and selling securities. We are investing in the same securities. The risk will be low, but the return again will be low. The variance in return will be low. All right. So the correct answer accordingly, first statement is correct, second is incorrect, third is correct. So 1 and 3. All right, 1 and 3. Active management involves a higher risk. Passive portfolio does not involve frequent buying and selling to beat the index. It is the characteristic of active portfolio management. I hope this is clear. The two types of portfolio management. Yes. What about the other two type? Regarding the discretionary and non-discretionary portfolio management, evaluate the following statements. Discretionary management allows the manager to take investment decision without client intervention. Non-discretionary involves investor to approve and execute the investment decision. Discretionary PMS is ideal for the clients with limited investment knowledge and time. Non-discretionary involves a higher fees due to full control given to the manager. I want you to answer this question. Which of the statements are correct? 1, 2, and 3, 1 and 4, 1, 3, and 4, or all of the above? 1, 2, 3, and 4. These are the other two types of portfolio management. So, discretion. Discretion means authority. If I'm giving someone complete authority, it means they can do anything that they want, right? D. No, actually, fourth statement, you need to read it more carefully. It is saying non-discretionary PMS involves a higher fees due to full control given to the manager. Is it? Is it true? No. Right? In the discretionary management, full control is given to the manager. They can make investment decision without client intervention. In the non-discretionary, the involvement will be less. They will just give advice. Yes, the correct answer is A. No, not B, not B. The correct answer will be A. All right. In the non-discretionary PMS, the investor will just give the advice, and the final decision whether or not to invest will be of the client, will be of the investor. So if the investors, they do not have enough knowledge, they do not have enough time, they can give the complete control of their portfolio to the manager. Complete control is there, so higher fees will be there. In the non-discretionary, a lower fees will be there. All right, so the correct answer is A. In the non-discretionary, they only suggest the investment ideas. The investor will be responsible for choosing. The final call rests with the investor. In the discretionary, complete control is given to the portfolio manager. All right, so the correct answer is A. Do K. It is A. Next, under SEBI's revised portfolio management services regulations, effective from October 1st, 2020, what is the maximum operational fee excluding brokerage that is permitted annually? So the portfolio management services come under the regulation of. Okay, you have already given the correct answer. Yes. Options are 1%, 0.5%, 0.75%. So the correct answer is C, 0.5%. The new set of regulations given by SEBI announced in February 2020. No upfront fees will be charged at the time of entry. Upfront fees is no there. Operational fees, depending upon the client's average asset under management, will be 0.5%. It cannot exceed that, right? It cannot exceed that. If including brokerage is given to the decision to decide the brokerage is given to the portfolio manager. Between 2% to 5%, they demand the brokerage fee. All right? Brokerage fee, they can themselves decide. Between 2 to 5% is the market accepted brokerage. Hmm. Then exit load. Let's say if the client is taking the portfolio management services and they want to exit in the very first year, then exit load will be 3%. If they exit in the second year, it will be 2%. If they exit in the third year, it will be 1%. If the client exits the scheme after 3 years, no exit load can be charged. All right. Then clients should be onboarded directly. Client engagement with intermediaries and distributors should be avoided. A chartered accountant will certify the minimum specified net worth of the portfolio manager to be rupees 5 crores, and a monthly report will be given by the manager to the client in which they will include the expenses, the performance, buying and selling, cash holding, investment in the liquid form. All right, so this is the new set of guidelines issued by SEBI for portfolio management. Okay, advantages and disadvantage. One biggest disadvantage of portfolio management is that the fee arrangement is quite high, right? Profit sharing returns, typically 20% can be charged. Also, there's a minimum requirement only of a surplus, only then you can get the portfolio management services. A minimum corpus of rupees 50 lakh to start investing in the portfolio management. All right. Okay. Next question. Evaluate the following statements regarding the financial year and assessment year. Financial year is the year in which the income is earned. Assessment year is the year in which the income is taxed and the returns are filed. Both financial year and assessment year run from April 1st to March 31st. Assessment year precedes the financial year. So which of these statements are correct? 1, 2 and 3, 2 and 4, 1, 3 and 4, or all of the above? So in our tax planning unit, we have studied about the indirect taxes and direct taxes, direct taxes on the income and profit, indirect taxes on the purchase of goods and services, indirect taxes, service tax, excise duties subsumed under GST. Then for the paying of tax, we have the concept of yes, the correct answer is A, financial year and assessment year. Financial year is the year in which I am earning income. The financial year 2025 26, 2025 26 has already started. The income that I will be earning from April 1st, 2025 till 31st March 2026. This income will be taxed in the succeeding assessment year 2026 27. So for the financial year 2025 26, assessment year is 2026 27. All of us would have filed our ITRs in this year. So for the assessment year 2025 26, we would have selected it in our ITRs. All the income that we earned in the financial year 2024 25 was taxed. All right. And the assessment year succeeds the financial year. It comes right after our financial year. Financial year and previous year mean the same thing, in which the income is earned. Assessment year, in which the income earned is taxed. Why do we tax it in the next year? Because the government cannot tax us on the income that we have not yet earned. So when the complete financial year is done, then we are required to pay the taxes. Another important topic from tax planning is the criteria of residentship, because paying the tax, citizenship does not matter. I can be a citizen of any nation, but if I am a resident of India, I need to pay taxes to to the Indian government. So which of the following conditions must be satisfied for an individual to qualify as a resident? Ordinarily resident. So once an individual is classified as a resident, we will see whether they are a resident, ordinarily resident, or a resident not ordinarily resident. If they are not a resident, then they will be a non-resident. So tell me the conditions for the ordinarily resident. Resident in India for 2 out of 10 years and 730 days in the last 7 years. Resident in India for 5 out of 10 years and 365 days in the last 5 years. Stay in India for 182 days in the current year only when the income exceeds 15 lakh, and no foreign liability. This statement is very important. I will explain you. No, okay. Let me explain it to you. When will a person become a resident of India? Person can be individual, person can even be a company and office which is owned by them. For qualifying as a resident, stay in India should be more than 182 days in the preceding financial year, plus stay in India for the immediately preceding years should be more than 365 days. Preceding 10 years, 365 days. Plus in the immediate financial year, more than 60 days. If these two things are satisfied, you will be a resident of India, right? Any of the two, either this or this, either the first condition or the second condition. This is the residentship. Once either of the two is checked, then we will check whether whether the person is a ordinarily resident or not ordinarily resident. So to be eligible as a ordinarily resident, a resident for India in at least 2 out of 10 preceding financial years, plus this is not either or condition. If the following two conditions are met: first, 2 out of the 10 immediately preceding years, and in the immediately 7 preceding years, more than 730 days. If these two things are fulfilled, then you are a resident, ordinarily resident. If not, then you are a resident, not ordinarily resident. And if neither condition is fulfilled, then you are a non-resident. All right, so the correct answer will be A. Resident in India for 2 out of last 10 years and 730 days in the last 7 years. Why will we check this additional criteria? We will see this if in the immediate preceding financial year my stay is not more than 182 days, but in the preceding 10 years, at least for 2 years I have stayed in India, and in the 7 years at least 730 days, right? So the correct answer is A, and I said that the fourth statement D is very important. Why? Let's say there is a non-resident, an individual who is a citizen of India, who is not liable to pay any tax in the other country, right? Then that person would be known as a deemed resident, a deemed resident. You are an Indian citizen, but you are residing, you are a resident of any other country. You will be a deemed resident in India if you are not taxed by the government of that country and your income is more than 15 lakh rupees. So you will be required to pay taxes to the Indian government. All right, so the statement D, income exceeds 50 lakh and there is 15 lakh and there is no foreign tax liability. It is related to the deemed resident. This can also be asked in the exam. All right, next, with respect to the taxability of residents and non-residents, consider the following statements. The resident, ordinarily resident are taxed on global income. Non-ordinarily resident, non-resident are taxed on Indian income only. The double tax avoidance agreement, DTAA. This is double taxation avoidance agreement. Helps avoid double taxation on the same income by two nations. Resident, not ordinarily resident, guarantees exemption from Indian tax, income tax on the foreign government. Which statements are correct about taxability? 1, 2, and 3, 2, 3, and 4, 1, 3, and 4, 1, 2, 3, and 4. What is the correct answer? Yes, the correct answer is A. So for the resident will be taxed on their complete income that they're earning in India, as well as on their global income. So both resident and resident, ordinarily resident. I am receiving my income in India from the company in which I'm employed. Let's say I'm also exporting certain goods. I'm receiving income from there. On that income, I will be taxed. I am also providing some honorary services to a foreign university. I am teaching as a lecturer there part time. I will be taxed on that income by the Indian government as well if I am a resident and resident, ordinarily resident. All right. In case of non-resident and not ordinarily resident, the tax liability is restricted to the income that they earn in India. All right. No tax is applicable on their foreign income. So global income of resident and not ordinary resident is not taxed by the Indian government. DTAA, this the Indian government will enter into any other country in order to avoid paying double taxes on the same income. All right, so the correct answer is A. Moving on. With respect to the long-term capital gains classification, consider the following statement. This is another very important topic. Capital gains. Not ordinarily resident, deemed to be resident, both are same. No. Not ordinarily resident would mean that they are not satisfying any of the criteria. The first criteria, deemed resident, means they are a citizen. Doesn't matter for how many days they have remained in India. Even if they have stayed in India for 0 days, but they have the Indian citizenship, they will be taxed. And the tax liability will be different for them. They do not mean the same. All right, tax liability will also be different. Hmm. Okay, now let us answer this question. The residential house property held for 25 months qualifies as long term capital asset. Listed debentures held for 13 months qualify as long term capital asset. Bonus shares holding period starts from the date of original share purchase. Inherited assets include previous owners holding period for classification. Okay, a bit tricky. Read the statements very carefully and then answer. You need to check the time period for each of these assets that are given. What is capital gains? Capital gains that arise from the selling of capital asset. Capital asset can be immovable property, it can be shares, it can be debentures, vehicles, trademark, land, machinery, jewelry, everything. Short-term capital gain would mean asset which is held for a period of less than 24 months, immovable property less than 24 months, other assets, assets like equity or preference shares on a recognized stock exchange, securities on a recognized stock exchange, units of UTI, equity oriented mutual fund, zero coupon bond held for less than 12 months, they are short term. Held for more than 12 months, they will become long term. And yes, the correct answer is C. So if I'm holding a residential house property for more than 24 months and then I'm selling it off, it is a long term capital asset. I'm holding debentures for more than um, 12, 12 months, again long term capital asset. An inherited asset, let's say I inherited a house from my parents, that is not a transfer, that is not a capital gain, but I'm selling it off to a third person after 24 months of me getting the transfer. That will be a long term capital asset. All right, so the correct answer is C, 1, 2, and 4. 1, 2, and 4. The third statement, in the case of bonus shares, the period of holding is counted from the date of allotment, not from the date of purchase. All right, the date of allotment of the bonus shares, all right. That is why the third statement is incorrect. All right, which of the following reinvestment options does not qualify for the long-term exemption under the relevant section? So there are three sections that we talk about: section 54, section 54F, and section 54EC. Which of the following is not correct? Not correct. Purchase of two residential properties under section 54, investment in the National Highway Authority or Rural Electrification Corporation bonds under section 54EC, construction of the residential property under section 54F, purchase of agricultural land under section 54F. Yes, the section 54F does not talk about agricultural land. It talks about capital gains on the sale of any asset other than the house property to be invested in a new residential house property, not on agricultural land. Okay, so section 54 exemption is there. Sale of house property, I'm using the proceeds to purchase another house property, should not exceed 2 crores. The capital gains should not exceed 2 crores. Section 54F, exemption on capital gains on sale of any other asset. I am selling any other asset, a vehicle, jewelry, machinery, but I am investing the proceeds to purchase a new house property, right? And 54EC, Sale of the house property, I'm investing the proceeds into specific bonds. Maximum, the property that can be reinvested up to 50 lakh rupees. All right, so these are the three important sections where I can claim deductions. My capital gains tax can be exempted. All right, these sections are in IT Act, yes, in our Income Tax Act. They are given in our Income Tax Act. Okay, hmm. Let's move on to the next question. Which of the following term, which of the following life insurance policies offers periodic payouts during the policy term? A term insurance policy, endowment policy, money back policy, or critical illness rider. So when we are talking about insurance, insurance can be a life insurance, it can be general insurance, asset insurance, health insurance, right? Insurance schemes for life insurance product can be endowment policy, term insurance policies, or money back policy. Yes, this was a very simple question. The correct answer is C. Periodic payouts during the policy term, money back policy. What is endowment policy? Here, to pay a lump sum after a specific term on maturity on or death. So the endowment policy, even if the policyholder does not die, on the maturity, they are going to get some lump sum amount. Okay. Term insurance policy, on the other hand, for unfortunate demise of the policy holder, their nominees or the family member will get the lump sum amount, right? During the lifetime, or if the policy holder does not die, they're not going to get any benefit apart from the tax benefit. They can only claim the tax benefit, right? At the end of the policy, no monetary benefit is there. Money back policy, it is a sort of endowment policy. The policy holder receives a fixed amount at specific intervals, and in the event of unfortunate death, the full sum assured is also paid. All right, so here the correct answer is C. This is the characteristic of a money back policy. Very important question. When the banks are providing insurance products, they have the option of acting as a broker, an agent, or they have the option to directly sell insurance product, forming a subsidiary or joint venture. If they are doing it departmentally, acting as broker, they cannot participate with risk participation. With risk participation, only through a subsidiary or joint venture, it is allowed. Okay, so the bank must have the net worth of rupees 1000 crore before investment. Net worth must remain 500 crore after investment. Net NPA must not exceed 3%. Bank must have made profit in any one of the last 5 years. No, correct. The correct answer is A, 1, 2, and 3. Profit should be made in the preceding 3 financial years. All right, a profit in the preceding 3 financial years is necessary. And the track record of the subsidiaries should also be satisfactory. If they're undertaking the insurance broking services through the subsidiary, this net worth of 1000 crore will not be required. Net worth should not be less than 500 crore, just that. Other things remain the same. Departmentally, all they need to do is have a board approved policy, grievance redressal, customer appropriateness. They will also have to pay a license fees, non-refundable deposit of 50 lakh rupees to be maintained with another scheduled commercial bank. All right, so this topic is important. Revise it thoroughly. Okay, with respect to the Pradhan Mantri Jeevan Jyoti Bima Yojana termination conditions, departmentally, RBI permission is required. No. If they want to undertake the insurance broking services departmentally, they need to get license from IRDA, the Insurance Regulatory and Development Authority of India. All right. If they're setting up subsidiary or joint venture, then RBI's permission will be required. License from IRDAI will be there. Okay. License from IRDAI, deposit of 50 lakh rupees. Hmm. So the Pradhan Mantri Jeevan Jyoti Bima Yojana is a social security scheme guaranteeing life insurance to the policy holders, right? There's the eligibility condition. Any individual in the age group of 18 to 50 years are eligible. 18 to 50 years, right? 2 lakh rupees is payable on the member's death due to any cause. They are going to subscribe to the scheme through the eligible bank account, KYC compliant bank account. Aadhaar would be the primary KYC. Termination, you are saying C, 2, 3, and 4. Correct. When will the scheme be terminated? There's the auto debit facility. Automatically, the premium 436 rupees per member per annum should be debited from the bank account. On attaining 55 years, it will be terminated. Closure of the account, insufficiency of balance, it will be terminated. And even though the customer is allowed to hold as many bank account, but they can subscribe to this scheme only through one account. If they're found to be availing the benefit through multiple accounts, the second account will be closed. Premium received will be taken back. All right. So this is the termination points. So the correct answer is C. Coverage will not be terminated if the nominee details are not updated. Nominee details not necessary. All right. What is the purity level of India gold coins? There's also the Pradhan Mantri Suraksha Bima Yojana. It is the accident insurance scheme. It provides accidental death coverage as well as the disability coverage. Right? 2 lakh rupees for death, 1 lakh rupees for loss of sight of one eye, use of one hand or foot. These things are there. Remember the difference between the two scope of coverage, 18 to 70 years. So what is the purity level? Yes, it is 24 carat at triple nine fineness. So the India gold coins is brought to the public by the Indian government under the Make in India scheme and the gold monetization scheme. 24 carat purity, triple nine fineness, minted in India with the Ashok Chakra. They will be supplied in the domestic market only. MMTC has been clarified to issue to mint these coins. All right, so 24 carat, triple nine fineness. Which entities are not eligible to invest in the sovereign gold bonds? Individuals, Hindu undivided families, trusts and charitable institutions, or NRIs? A, B, C, or D? Which of the following entities are not eligible to participate in the sovereign gold bonds? Yes, NRIs are not allowed, right? NRIs are not allowed. So the sovereign gold bonds are also government securities denominated in the grams of gold. Holding gold in the physical form is risky. It is costly. Gold can also be stolen. To avoid such things, we can choose to invest in the digitized form of gold. For that, the government issues these SGB. All right, rate of interest 2.5% per annum. I can pay the issue price in cash. I can redeem the bond in cash on maturity, free from making charges. Purity, again, highest purity is available. Okay, the price will be determined by the India Bullion and Jewelers Association Limited for the last 3 business days. It will be published on RBI's website as well, right? Who all are eligible? Individuals, HUS, trusts, universities, charitable institutes, but not NRIs. Only person resident in India. There's also the limitation like individuals 4 kg, Hindu undivided family also 4 kg. For trusts and institutions, charitable trust, it is 20 kg. So starting from 1 gram in multiples, the bonds can be issued. I can subscribe it, right, from 1000 rupees, and then in multiples of that as well, the subscription can be done. There's also the option of subscription digitally in the online mode. One discount of rupees 50 per gram will also be given. All right, rupees 50 per gram. So that is all. The bond period maturity is 8 years. We have the option of exit after 5 years. Right? Interest. Okay. So these are the things under the sovereign gold bond. Do we have anything else? No, this is important. Making charges discussed, interest rate discussed, maturity also discussed. All right. Interest is taxable. Interest is taxable. The interest on the bonds will be taxable, but the capital gains will not be there, right? The capital gains tax has been exempted. If I sell off my sovereign gold bond, then whatever capital gain is arising out of it, or when I redeem the SGB, the capital gain arising out of it, that has been exempted. But the interest on the bond is taxable as per our Income Tax Act. All right. So that is all. We have completed the most important topics from our module D. There are other topics as well that we'll be covering in our full marathons. Okay, so that is all. I hope you all are preparing well and great. You answered almost all the questions correctly. So good going. You are good going. Yep. Okay. For those who have not started preparing, you can join the JIB Super Elite plan. We have started with our revision classes, the crash and cracker batches. We'll be discussing all of these important questions in these revision session. Another important information for you, when you're preparing for your JIB exam, there is the JIB readiness test. In the description, you are going to get the link where you can attempt from this for this test. In 2 minutes, 10 questions, the most important topics will be asked. All right, so you'll get the link to it in the description. You can click on the link and attempt this test. Right, so that is all from my side today. I hope this session was useful. And before you leave, do like the session, share it with your other fellow aspirants, subscribe to the channel because we are bringing these important sessions for you. And we still need to cover our module E. After our mini marathons, we'll be starting with our mega marathons on the YouTube channel itself. So thank you so much for attending. All the best for your preparation. Good night. Take care. Bye bye.